Have your credit card statements been causing you dismay lately? Welcome to Hear the Web. I'm Tom.
And I'm Lily. A significant concern for many of us is the skyrocketing interest rates on credit cards, some even suggesting they're nearing loan shark territory. A worrying thought, wouldn't you say, Tom?
Absolutely, Lily. Stories abound about these interest rates reaching historic highs. Barry Glassman, a certified financial planner who's a member of CNBC's Advisor Council, gave voice to these concerns. He noted that the average interest rate for all credit card accounts hit an alarming 20.68% in May. Makes you rethink those shopping sprees, doesn't it?
It certainly gives pause, Tom. It's like a sword of Damocles hanging over the head of consumers. In this scenario, being debt-free seems more of an aspiration than reality. But interestingly, Ted Rossman from creditcards.com challenges the loan shark analogy.
You're referring to his point about payday loans charging up to 600% and making credit card rates seem less severe in comparison. Yet, Rossman acknowledges that credit cards do carry the highest interest rates in mainstream consumer debt, which is why he stresses the urgency to prioritize credit card debt payoff.
Worth hammering home that point, Tom. High interest rates, especially those over 20%, can have a devastating snowball effect for consumers. In fact, it's rather disheartening that 37 out of 100 cards tracked by creditcards.com currently cap their APRs at 29.99% or more, a record share.
Talk about a seismic shift, Lily. Picture this. Total credit card debt topped $1 trillion in the second quarter of 2023, a milestone we'd all rather forget.
Indeed, Tom. To grasp the gravity of the situation, let's look at some numbers. There are 70 million more credit card accounts open now than in 2019. In the second quarter, 69% of Americans had a credit card account, up from 65% at the end of 2019 and 59% at the end of 2013.
A massive increase. No doubt about it, Lily. Yet interestingly, despite these growing numbers, delinquency rates among cardholders seem to have stabilized around pre-pandemic levels. That's a testament to the resilience of American consumers, wouldn't you say?
Resilience indeed, Tom, but rising balances can pose significant challenges. Consider this. The average credit card balance is $5,947. Making the minimum monthly card payment means a borrower will be in debt for 211 months and owe $8,811 in interest. The very thought gives me chills.
Same here, Lily. What's more is the concern about the Federal Reserve sharply increasing its benchmark interest rate. That's made a noticeable impact on borrowing costs across different types of debt. According to Glassman, the consequences are already starting to show with failures of banks like Silicon Valley Bank and Signature Bank earlier this year.
Another loop in this financial roller coaster. Adding to that, Glassman points out the imminent restart of federal student loan payments after a pause of over 3 years. This, he says, will be an immediate pay cut for borrowers. Just imagine, borrowers owe a collective $1.7 trillion in student debt.
What a sobering thought, Lily. It's becoming even more of a challenge, as the option to refinance at lower interest rates has essentially vanished due to these rising rates.
So, what's the takeaway from all this, Tom? It's clear we are amidst a financial storm and the future looks uncertain. Is it a warning bell for more financial crises, or does resilience and survival instincts kick in?
Well said, Lily. Listeners, as we step into the uncharted waters of escalating interest rates and high balances, remember, knowledge is power and informed decision-making is essential. Take charge of your financial journey, prioritize payoff, and try not to get buried under the crushing weight of credit card debt.
Couldn't agree more, Tom. Keep in mind, you make the cards work for you, not the other way round. Until next time on Hear the Web, stay curious, stay informed, and take control of your financial destiny.